Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I was just kind of reading through a lot of the comments. I kind of want to make this statement and I went over a whole bunch of technical analysis this weekend. We went over a wide variety of a whole bunch of different areas in terms of commodities. We went over metals, fertilizers, lithium, energy sector. I mean, we went over a whole bunch of different things. Diversified mining companies, they are all extremely bullish. Home builders, they're breaking these very, very large patterns. In my opinion, the way to play this, the strategy, the way to look at things is my journey through investing, looking at all these things, you make money by basically developing a strategy, by looking at these big picture view patterns, by looking at the market conditions and ratios. Everything right now is in alignment. Everything. I'm showing you that through all of these different videos, giving you the updates, giving you my opinion on everything. This will, and I wholeheartedly believe this is the most valuable information that you can get on YouTube or anywhere on any website. And the way that you have to do is you have to create a strategy. You have to figure out what companies to invest in. We've got all the perfect alignment for a commodity bull market that's coming. And how do you play it, right? I'm not saying that you have to go 100% in. I'm not a financial advisor. I can't give you guys financial advice, but I can tell you what I am doing in the companies that I'm looking at. I can do that. And my strategy, and I'll tell you my strategy in this clip, I'll be talking about strategy and what I've learned in my investing over the years and how I've migrated towards a certain investment style and what works for me and it will probably work for most everybody. So when I was young, I didn't have a strategy. I didn't know about market conditions. I didn't know about ratios. I didn't know how to value assets. I didn't know technical analysis. I didn't know any of this stuff. That's basically your default position. And over the years, what I've learned is that you have to create a strategy. A strategy is to find out where the risk is, where the rewards are, where the asymmetric bets are in the market. What does that mean? What's an asymmetric bet? An asymmetric bet means that you have large upside potential and you're investing in these things at a time where there's low downside risk. Commodities is that sector at this time. It is the cheapest in terms of ratios, in terms of value. And a ratio is just pricing an asset against an asset and comparing it to time. So you find what's undervalued and cheap. You find what the potential of the upside can be. If you're looking at potential upsides, I have identified a whole bunch of different sectors with huge upside potential. I do think home builders have good upside potential. Fertilizer companies, energy has massive potential. That's where I really like. Precious metals are good. And then some of the base metals. There's opportunities in all of these areas where there is massive asymmetric bets, big upside potential, low downside risk. Not all the companies are going to do extremely well in this next bull market. There could be explorers that are duds. So what I would look at is I would migrate towards those that can do a little bit of everything. Maybe they're a producer, they're a developer, and they're an explorer. So they self-fund themselves to explore. One company that I can think of is EXK, Endeavor Silver. That one seems pretty compelling for an investment. And one of my favorite silver companies. First Majestic Silver is another one that I would probably be looking at as well, just to name a few for examples. Be careful on loading up too much on the exploration side. They can have problems. And be careful on developer companies where they could have technical problems if they're only developing one mine. You could also have nationalization risk and all this other stuff. So my strategy has changed over time where it's been more of the developers and the producers and a mixture of both. You can't get too heavy in the exploration companies. You can take some money, maybe it's 5% of your portfolio or something, and they've put it towards the explorers and swing for the fence. And then what I do is I create a strategy an investment strategy where I divide it out small amounts of money and spread it across what I think are the highest probability bets. Massive upside potential, but they do carry more risk. So that is one strategy that I kind of deploy is I take small amounts of money and divert it towards exploration companies. I put the big money in royalty companies and in the producing companies. So I have oil producers. That's where I have a big amount of my money. I do have some money in uranium developers because there's not many producers in uranium. And then I have a lot in the royalty companies. Royalty companies receive royalties off of income. It's basically streams of income. They've got many royalties across a whole bunch of different mining companies. It's diversified by nature. It's a bet off of volume and price. So if the price goes up and the volume of whatever that miner is producing, they get a certain percentage of it as a royalty. And you don't need a lot of people to run that company. There's really no input costs. It's a very good business model. So I chose to put a lot of money in precious metals royalties, and I've branched out into base metal royalties and stuff like that. So big royalty fan. Will the moves be as big as some of these small mining companies? Probably not, but I think it's got enough leverage and such low risk that I don't know, I just prefer the royalty companies over basically everything else. And if it's got a really good pattern, you'll see me continually cost averaging into it. I already own massive positions in diversified mining companies and royalty companies. I've got a good chunk of my money in those types of companies. If you look at my other videos in diversified mining companies and royalty companies, you can see which ones, the daily technical analysis update videos, a lot of those companies are the ones that I own. And I don't own a ton in the very small exploration companies. I know a lot of people want to load up to the hills. Maybe it'll work for them, maybe it won't, but I have enough money where I don't need to have that amount of leverage and take on that amount of risk. I just need to capture the big move with some leverage, and I think I'll do just fine. Energy is a big portion of my portfolio as well, and I would say the majority of my strategy is focused around energy itself. I overweight the energy sectors. I overweight royalty companies because I think energy will get quite expensive in the future. I also think that the metals themselves, the physical metals, will go up quite dramatically. With the physical metal going up, the mining company may not make as much money as what you think. We have declining ore grades over time, which means that your energy inputs are continually going up. And if energy goes up at a substantial pace, the commodity will go up as well, but the mining company may not make as much money in that scenario because we're talking about a bet on margins. You want their margins to increase, or you want the volume of what they're producing to increase. So your bet there in a mining company isn't necessarily the commodity price solely. It's the commodity price in relationship to their input costs, which is their margins, and the volume that they can produce. And there's risks associated with producing this stuff. And that's why usually it provides leverage to the move. So long that the risks don't overweight or ruin those returns. So there is a lot more risk in mining companies. It is a dirty process. And the world in general doesn't want mining anymore. It's dirty, it's environmentally damaging, and people are looking at it with a negative viewpoint. So the physical metals are by far the least risk way to play it. It's a great way to capture the price of the move of whatever commodity is there. So I have a mixture of physical metals in my portfolio. It's about 30% of my net worth, physical precious metals. I know it's not a big, huge leverage play. I'm a pretty conservative guy, I guess. I've got 30-something% roughly in a home that I own, and then you've got about 30% or something like that, or more, 40%, about 40% maybe, in these mining companies and liquid assets and all sorts of stuff with stocks and stuff like that. So that's kind of how I break it down. 30%. If I could choose, 33% physical metals, 33% real estate, 33% stocks, I think that's a pretty good mix. That's just me and kind of how I dealt it out. Now, could the stock side blow up during this commodity bull market and be 60, 70% of my net worth? It could. It could. And what I'm going to do is I'm going to divert more of that over to other things. I'll buy more real estate. I'll buy more physical precious metals, and I'll continue to diversify out at that top. And then if we get a crash in the housing market, I'll buy another very nice house to diversify out and continually to build and try to keep it around that 33% area. So that's kind of how I break out the money for me. Doesn't mean it's right for everybody. I'm more heavily in the commodity sector just because that's where I think the opportunity and the rewards are. So my strategy is 33, 33, 33. I am leaning more towards royalty companies, diversified mining companies, and producing companies. I have a good chunk in developer companies, ones that are developing mines, and then I have very little money in exploration. And if I'm going to speculate on something, I usually will put it in a maybe a small royalty company to push the leverage. So I'm using a diversified approach. I want price and volume, and I'm using the small cap like a Teuton Resources to get the leverage. So that's what I'm using as my quote riskier play are the smaller royalty companies, and I diversify across those like a Teuton Resources, Sandstorm Gold, like a Cisco Gold Royalty, even though that's kind of bigger. Those types of plays, Mavericks Metals. I had an Ely Gold, which is now Gold Royalty. Those types of things. And Nova Royalty is a very small speculative one that I've been for nickel and copper. So that's the strategy there. And that's kind of how I'm viewing things. What I've learned over all these years is to basically set up a portfolio similar to what I just said. That's what I've learned. And to play the physical portion more than what most people are doing, because that is a for sure move if you're going to have a commodity bull market. The commodities will go higher. That is for sure. And you've got least risk in terms of taxes and nationalization and not just taxes on yourself, but taxes for the companies and corporations and whatnot if these commodities go to the moon. It's a diversified way to play it. And that will just increase the costs of doing business, which means the cost curves go up even higher. And the commodity prices should go up with it. But what I've learned over all these years is I've done. You can see that I do technical analysis. I do all that stuff. It doesn't mean I'm the best at it. Maybe I am. Maybe I'm not. It's what I've learned is on the short term, it's very hard to read. Very hard to read very short term movements because anything affects the movement. Anything. News can affect it. War can affect it. Someone having a bad day. The Federal Reserve comes out, says something that people don't like. It tanks. Anything can affect it in the very, very, very short term. What I look for are the structural market conditions that are underneath this market that are basically forcing people or influencing people to invest a certain way. Forcing usually comes with interest rates and people losing money. It's a negative feedback. So they want to put their money in something that's going to go up, which will be commodities in an increasing interest rate environment under a highly inflationary environment. That's what I've seen in history. So precious metals, commodities, and real estate is a good spot, I think, to be in this type of market environment. And then what I do is I ride that entire trend. I don't trade in and out. I don't try doing the short-term stuff. I don't worry myself with it. I don't put a lot of leverage on the move either. I don't have to sit there and put a bunch of options on it. If I'm going to play a leveraged move, I usually do warrants. Warrants are usually issued at the bottom of a market when a company goes bankrupt or they have problems. So they issue warrants out, or it's a company that's very small and new where they can issue some warrants. You can buy those warrants over the markets, just like you would a stock. And a warrant, what happens is it's usually out of the money, so to speak, kind of like an option. Like it's out of the money, it's not worth anything, or it's worth something, but it's not worth as much when it's out of the money. When it's below the price of its exercise price, and usually there's a time frame tied to it. So if it's a 2024 warrant, you can get it in a deal if you buy a deal, or you can buy it off others. Oasis Petroleum had one in the beginning. I bought some of that. They went bankrupt. They released some warrants. I was watching it, and then I bought some of the warrants for very cheap, and now they've gone up a ton. It's basically a little bit more leverage to the move, When it goes over the strike price, let's say you get the warrant, it's at, you pay very little money for it, and let's say it becomes in the money, so to speak, or you can convert it above a certain price at, say, $10, and the stock is trading at $2. The warrants are really cheap, and usually they've got some period, 3, 4, 5, 6, 7, 8, 9, 10 years, whatever it is, and you buy it, and once it goes above that price, you get whatever that price goes above, you get as a return. So once it goes above it, it really starts to generate a lot of money for you. So I take a lot of these, like, companies that have gone bankrupt in oil. They've released all these warrants. You can do it in precious metals as well. And then I buy some of them. I'm not a ton, but I just buy some. I hold on to it, and sometimes they turn out very well. So I do have a little bit of money in that. I've kind of incorporated a little bit of that in the strategy. I don't play too much in options because the time is too short and compressed. What I've learned is that the structural underlying market conditions take time to basically materialize, to work. So, if I were to buy something now, a 2026, 2028 timeframe would be a perfect kind of end date of something going up. So I own the majority of just stocks, and I ride it the entire time. If I'm going to put leverage to the move, I'll get a warrant that's out in 2024, 2025, 2026, if it goes out that far. If they have something that goes out that far, that's great. Maybe that's worth playing. It's probably going to be out of the money, and it's going to be up a ways up there for a lot of those. And maybe I'll do that if I can get a really good deal. So that's another way that you can play. And I know some people, since I brought up warrants, are probably going to want me to do a whole video on warrants. Maybe I will, maybe I won't. I don't know. I don't want people to get too focused on leveraging up too much. The leverage moves here, if you stick with a lot of the producers and whatnot, which most likely won't have warrants on them because they probably didn't go bankrupt. Those are the ones you want to stick to get the for sure move. You don't have to go to the hilt on the leverage, in my opinion. The moves will be so big and the moves will be so great that you don't have to do that. And play the big long-term moves. The markets move in cycles. They go impulse, move higher, consolidate. And usually the consolidation periods are quite long. It gets pretty boring. I'll be honest. Investing is a game of patience. It's a game. Think of everything as like a long-term ride on an airplane. Airplane rides are pretty boring if you don't have anything to do. You just sit there and you're like, man, this is really boring. That's what investing is. Money gets made really quick. It just blows up in a big impulse move, and then it consolidates for a bunch. And then a big move up and consolidates. You have to be in the market when it goes up, those big moves, those big impulse moves. Sometimes you get lucky and you get a nice, good, straight, just move higher for many years. That's perfect. But sometimes you get these companies, they impulse move higher, they consolidate, impulse move higher, consolidate. They call it stair-stepping higher in that fashion. Pretty boring. Just stick with it if the market conditions are good and the ratios are good. That's my strategy. That's what I'm doing. Strategy, 33% gold, physical precious metals, 33% real estate, 33% equities and type movements. Anyone who's a financial advisor is going to tell you that's absolutely horrible, but they make their money off of equities. So, of course, they're going to tell you that you should be more in equities. But that's kind of how I view things. Strategy, buy and hold, buy the producers, buy the developers, put very little money in the explorers. That's another thing. I don't have certain percentages. When I see an opportunity, I take that opportunity and I invest in it. I don't care what the percentage is. I don't have to stick to 20% uranium. I don't have to stick to 20% oil. I don't have to stick 20, 20, 20. I don't even care about that. If you give me a great opportunity, I'm going in. Now it's just what percentage of my portfolio am I going to limit myself to? Each position size, at most 5 to 10%. Do not go higher than that. You can't, if you lose that position, you can't lose 50% of your portfolio putting 50% of your money in one position. That's pretty risky. I mean, you could do it in an ETF. You could do it in maybe a diversified royalty company, but I probably wouldn't put that much risk in one spot. Now, so that's kind of the portfolio allocation. So usually I do about 5% as a max position size. So 1 to 5%. 1% or below are little exploration companies. I don't want to put a bunch of money in them. And then I put about 5% to 10% if you want to push it big on something that has a incredible technical analysis chart. that have done all the due diligence on, that I've done, that have complete conviction in with a ratio that's off the chart low that's about to break to the upside. So we've got like the perfect setup, like an SM energy at the bottom that I went kind of heavy in. That's when you go heavy. Then I cost average in throughout the time of money that I'm earning into these positions when they're down. When something's down, I cost average in. I buy it when it's cheap. I buy it when everybody's saying this, uranium's not going to go anywhere. I'm down on uranium. And everybody starts talking negative. I'm in there buying. I'm buying it up. Look at the charts. Buy it, buy. Just be this persistent guy or girl that's getting in there and just buying the dips. Buy the dip, buy the dip, buy the dip, and just hold on. Hold on. Buy the dips, hold the rips. Because if the market conditions are good, that's what's going to make you money. The big billionaires, the ones that made a lot of money, they rode the entire bull market of the market conditions. They are visionary. They look forward. They don't look at their portfolio and say, oh, I'm down 30%. Maybe I should sell it. That's not the viewpoint they have. The viewpoint is we have market conditions. This big event's coming. It's structural market conditions and fundamentals that are changing the market that will price these assets differently in the future. They invest massively and heavily in companies or develop their own companies, buy them, hold them, and ride it the entire trend. That's how they make big money. It's no different for everyone else. You make big money by riding the entire trend. You identify the assets that are cheap in the beginning. You buy the cheap assets. You diversify out amongst those cheap assets with very big rewards and little risk. You accumulate these cheap assets and you ride it for the entire trend. This takes years. Your time frame needs to be measured by decades, not by a year. If you're measuring it in months or weeks, your time frame's all messed up. All you're going to be doing is flipping around based off the news. It's too hard to do that, in my opinion. I have learned that that's not the way that I'm going to invest. I look at the big picture view. I invest for the next decade. What is cheap? What's the next opportunity? The opportunity that I see is in commodities and precious metals and all that. So I put my money there. That's what I see. That's what I view. That's my strategy. My strategy is to accumulate cheap assets. If aluminum's cheap, I buy aluminum. If fertilizer's cheap, I buy fertilizer. If they're all cheap, which we're kind of in that scenario, I sprinkle across all of them. I accumulate and accumulate and accumulate. And then what's going to happen is your portfolio, aluminum may take off, precious metals lag. Okay, so what? Your portfolio is moving higher. Energy's taken, oil's going to the moon, uranium's pulling back. It balances things out. But as long as you're making higher highs and higher lows, your entire portfolio should be chugging higher. If you put all your money in one sector, it's a little bit more, we'll call it psychologically testing, or you're going to have to, it's going to test you because you're going to get these large swings up and down. Diversification across the commodity group, so long that commodities will outperform, is a good strategy. Now, you can own stocks, you can own bonds. I wouldn't be a bondholder, but you can own a whole bunch of different stocks and diversify out and own some commodities. You don't have to be 100% commodities. You don't have to be 100% precious metals. You don't have to be 100% anything. Diversify across, get what you want, and do whatever strategy that works for you. But I can tell you this, going 100% into one thing is going to be quite difficult because you're going to see moves. If you're watching the channel, you're going to see moves in uranium that are ridiculous, and you're going to say, I should have bought that. And then you're going to go and chase it. Oh, I should have bought this, and then you're going to chase that. What you should be doing is you should be chasing what's down and chasing the value. Chase value, not price. Price is an indication of value, but chase things that are down. Chase things that are breaking chart patterns. Chase things that are up against resistance about to break. That is what a winning strategy is. Buy dips. Buy where things are about to rip. How are they about to rip? Use technical analysis, use the channel, subscribe to the channel, watch where things are about to break. When you start hearing me say, this is where I would be a buyer, maybe that's a key. Now, I'm not going to get everything right. I'm a human being just like everyone else. I'm not going to time everything perfect. I'm usually early to my entries. It's better to be early than super late. I'm not a price chaser. I try getting things that are down and buying off of support lines and buying things before they break resistance levels. So that's my strategy there, guys. That's how I'm playing this next commodity bull market. And yes, you can still own healthcare stocks. Yes, you can still own all this stuff. Health insurance companies, they've done absolutely incredible, like a United Health Group, Aetna, Blue Cross Blue Shield. I own Anthem, ANTM, UNH. I've held these for a really long time. They've done really, really well. I don't talk very much about the healthcare sector, even though I own a big stake in it. We do have an aging population worldwide. I think it's a great opportunity to own healthcare. The baby boomers are coming up; they're getting old. So that's another thing that I also play that I don't really talk about. I own emerging markets. I own a lot of these things. I'm not 100% commodities. So spread out across. Get your investments out there. It's about identifying the trends, identifying demographics, and all this stuff. And that's what we do on the channel. So that's kind of my strategy. That's kind of how I've put my money out there. That's what I'm looking for in producing companies, developer companies, or ones that can do all of it. I really do like oil and energy, and I like uranium and natural gas and coal. They're all good, guys. They are all good. Energy is the foundation of life, and energy is also the foundation of the ability to do work. And work is how we became advanced as a society. When these market conditions turn ripe, which they are, I think energy is going to absolutely kill it. I feel like we're botching an energy transition, and that's where some of the largest opportunities could potentially be. So I think uranium's very underappreciated, undervalued. The ratio's off the chart cheap. So yeah, I think that's a good spot to look at. There just isn't too many producers in that area. The only producers are CCJ, Camco, and Kazatomprom, and Paladin Energy will be a producer as well when they restart their stuff. But yeah, that's kind of how I'm playing this, guys. I just want to do a quick clip on it. Hopefully you guys, find value out of it. Give me a thumbs up for the content if you guys like the content. And thank you. Subscribe if you haven't. Thank you for listening. This is Finding Value.